UNP reported its earnings yesterday. It missed on both fronts. The stock is up after that earnings report. We are going to understand why. We're going to take a look at that earnings, a bit of a deep dive. We're going to take a look at the historical performance of Union Pacific Corp. As always, we're going to jump into the income statement, take a look at their revenues year on year, that bottom line, that net income to see how well it has performed. Jump into their balance sheet, take a look at their total debt versus their total cash. We are going to look at their dividend safety, run it through some very important financial metrics. And as always, towards the end of the video, we will take a look at that stock valuation model. What is the intrinsic value of a Union Pacific and what should our acceptable buy price be given our margin of safety? Now, before we take a look at the historical performance and understand the movements, we will very quickly jump into their earnings. And straight off the bat, we can see they do have a new CEO, and we can just take a very quick look here. Former operating chief Jim Vena as the top next boss. Wall Street love this news. They believe that he will be the person to guide them back to a successful operational company. And we can tell 10% up after that news. Now, in terms of the actual news that you'll be looking for in terms of the earnings, the top line figures, they actually reported a second quarter profit of $2.54 per share, missing analyst targets by quite some bit of $2.75 as volumes fell 2%. On top of that, they also missed their operating revenue target of $6.27 billion and reported $5.96 billion. So even though they did miss both top lines, both that earnings per share and that revenue, their stock still soared up over 10% based on the fact that Wall Street believe they have found their guy to take them back to the operational strong company they know they can be. Now, in terms of year to date, they are up 14.65%. It is trading towards that upper end of $242, and we can see that yield at just over 2%. Now, shareholders who have held the company over the last 10 years will be up around 164% without dividends reinvested. So very strong in terms of the historical performance. But what we want to understand is this going to continue over the next 10 years? And is it a strong company to put our money into for share price appreciation and dividend growth? So in terms of their financial performance, their total revenues, year on year, we like to see around 3 to 7% growth. We can see December 2018, $22.8 billion reported in revenue. 5 years later, December 2022, $24.8 billion. So it hasn't been incredible growth over the period. And in fact, when we take a deeper look, December 2018 to 2020, we can see consecutive years of revenue dropping. And then it's picked up from December 2020 onwards. In terms of how that has affected the bottom line, the net income, well, the net income has still grown over the last 5 years, just shy of $6 billion, 2022 just shy of $7 billion, and we can see here relatively flat over 18 to 19 and a drop from 2019 to 2020, and then it has picked up in line with the revenue. Now, in terms of their balance sheet, their total debt versus that cash position, which will then help us decide on how safe the dividend is and these financial metrics to support that. Well, their total cash has dropped from $1.3 billion to $830 in their latest quarterly report. Now, this is never really a red flag indicator, but it is good just to understand the movement and that position that they hold currently. Now, in terms of their total debt and the position and movement it has gone in, we can see here their total debt 2018 around $22.4 billion. Latest quarterly report, $34.6 billion. So again, it has increased. Again, it doesn't necessarily mean it is a red flag indicator, but it is good to know when we take a look at some other financial metrics to support that. So dividend safety score, 88, making it very safe. Market cap of $145 billion, making it a mega cap company. Now, for those who believe we are heading into a recession, we have a few metrics here. Recession dividend, they did maintain the dividend in the last recession, 07-09. Didn't cut the dividend, but again, didn't increase the dividend either. Recession sales, in fact, negative 21% was below the average growth rate during the recession period. And even during this period, for the majority of companies, it was negative growth. Recession return, however, of the actual share price, negative 42%, and this did beat the S&P 500's negative 55%. Now, they have been increasing that dividend over the last 16 years, and some phenomenal increases, 18% over the last full year. Last 5 years compounded annually at 15%. Last 20 years, 17%. Incredible growth, especially when I preach to all of you that you need at least a minimum of 4%, as that was the US inflation rate over the last 40 years. Otherwise, you are getting a pay cut, whether it's in your dividends, salary, or other income-producing assets. So very, very positive, very strong numbers. Now, valuation. So dividend yield theory states that a company is undervalued when the current yield sits above the 5-year average. So we can see here, currently looks to be reasonably valued, but we never look at any of these models in isolation and draw our conclusions towards the end of the video. Again, forward PE is roughly in line with that 5-year average. Likewise with the PE compared to the sector PE comparison. And as mentioned earlier, it is towards that 52-week high. However, as I always say, 52-week high does not mean overvaluation. Likewise, 52-week low does not mean undervaluation. Now, you've probably seen my videos, so you do know we look at the free cash flow payout as the earnings is susceptible to manipulation by management through accounting. And as I always say, it is one of my 7 golden dividend metrics to be below 60% to have room to grow that double-digit dividend we love to see. Fairly consistent in the 50s, 40s and 50s over the period. 2022, 55%. 2023 expected to be 57%, so still below that 60%. And we look to expect another double-digit dividend raise this year. Likewise, free cash flow per share is what I like to look at. $3.59 in 2013, $9.22 in 2022, so nearly a 3 times increase over the period, with 2023 expected to be roughly in line with 2022. So it's always good to look at least 10-year period whenever you're looking or analysing a stock to get a better idea of a company's operations. And then we move on to the sales growth. Now, this shows essentially the cyclicality of the business. Few years of single-digit growth, few years of single-digit negative growth, and so on and so on. 2021, however, we saw double-digit dividend growth as well as 2022. And hopefully we do get to see a third year of consecutive increases. However, if we do look at the historical performance, history tells us that we should be expecting a negative number. Total sales, $22 billion in 2013, $25 billion in 2022. Now, not incredible growth. In fact, very marginal, around 10% over the last 10 years, with some years coming in at negative. But if they can continue to essentially pay out large dividends as they have been doing, and something we'll touch upon very shortly in terms of their share buybacks, then this can still be a very strong business to invest in. Shares outstanding, as I mentioned, we love it when companies return excess cash to our shareholders. Now, this for me is essentially the golden standard of buying back shares. 932 million in 2013, 624 million in 2022. Essentially, nearly a third of their shares outstanding have been bought over the last 10 years. Incredible. They are essentially returning excess cash to our shareholders alongside paying that double-digit dividend growth. So lovely to see alongside the share price appreciation too. Another one of the 7 golden dividend metrics, ROIC, above 10% is what we need to see for management and effectively allocating their capital, in my personal opinion. Fairly consistent over the period between 14 to 19%. Very, very good to see. Likewise, they have smashed the operating margins consistently over the last 10 years, as well as that free cash flow margin. So very positive to see. Now, I did mention in terms of that debt level increasing, and from 2015, we can see that upward trend, which isn't something I like to see, especially when we look for below 3%, as it essentially saying 2022, 2.71 years for the company to pay off its debt net of cash on hand. 2023, however, it is expected to come down very slightly, but it is something I will be looking when they do release their annual report for 2023 in terms of their total debt figure. Net debt to capital, purely information purposes, 74% of the company's financing is from debt as opposed to equity, and we can see that increase. The company is using a lot of debt to finance their activities. We then move on to the stock valuation model. If you are enjoying the content, do smash that like button. Do hit the subscribe button for continued content on the channel. And if you want to run your own companies through the stock valuation model, do check the pinned comment below. Earnings per share at $11.32. Growth rate as expected by analyst estimates with that current yield on AAA corporate bonds. Intrinsic value coming in at $168, below the 52-week low, showing signs of overvaluation on this model. As always, we never look at one model in isolation. Now, we have companies in a similar sector and size. We have Norfolk Southern, Canadian National Rail, Canadian Pacific, and Old Dominion Freight Line. If you do want to check out stock reviews I have done of CNI and CP, do go check them out. We have the stock price, the EPS, we get the P multiples, of which you multiply the average by the EPS to get a UNP stock price of $284, showing some nice upside to that current share price and above that 52-week high. We then move on to the dividend discount model where we have the yearly dividends. We're still waiting on the dividend increase this year, so this number will change. Average growth rate over the period above 11%, and we can see I have gone for a 6% growth rate. I believe you could personally justify a higher rate, so if you do grab a copy of this model, you can play around with this to get your own, to essentially see what your own DDM price would be. So my DDM, based on my estimates and judgments, $275, again showing some nice upside to that current share price and above the 52-week high. Now, we move on to the free cash flow model. Free cash flow year on year, average growth rate 7%, forward-looking 10% per analyst estimates with the discount rate of 8%, giving us the present value of these future free cash flows and terminal value. If you add that together with the cash and cash equivalents, subtract the total debt, get your equity value, we have shares outstanding of 611, gives a DCF price of $260, again showing upside to that current share price. As always, do hit that like button and do subscribe for more content on your doorstep. So the intrinsic value here comes out to be the average of the four models at $247. If we take a look here, slightly higher than the current trading price and just above that 52-week high. Now, Wall Street do forecast the price over the next 12 months to be around $228, so they personally believe the stock is overvalued currently, but personally, this is more for information purposes. I personally don't listen or rely on what Wall Street forecast the price to be. Now, current price is trading around $236. Personally, margin of safety, I'd be looking for a company with a wide moat, strong financial metrics, and forward-looking guidance at around 10%. Now, I personally would be looking to buy normally 10% for UNP. However, given the issues they had with their earnings and their new CEO, I would be taking to look for a slightly larger margin of safety, probably personally around 15%. So I'd be looking to buy around $210. Now, I did buy a tranche of UNP when it was below 200 in the 190s, but because I do personally really like this company based on the financial metrics that we have just discussed and the valuation itself, I would personally be adding a second tranche around $210. If you are looking for a 20% margin of safety, however, you would be looking to buy around $197. And if we take a very quick look here, it is well within that 52-week range, and it was around that price not too long ago. As always, like, subscribe. Do let me know your thoughts in the comments. Are you looking to buy UNP? Are you looking to sell? Or are you shareholder purely on the sidelines? As always, have a great day. Catch you on the next episode and take care.